Welcome to Insights and Indicators. I'm Jason Thomas, Carlyle's head of global research and investment strategy. And in this podcast, I share our observations and opinions on the economic landscape, as well as insights from research being conducted by our team here at Carlyle. Today, I have the pleasure of being joined by Jeff Currie, Carlyle's Chief Strategy Officer of Energy Pathways, and we'll discuss the new Marshall Plan, Jeff's new research paper that explores the emerging role of private capital in rebuilding Europe's defense and industrial backbone. And that paper is available on the website, and I encourage all of you to read it. I look forward to discussing it with Jeff. But before we do, I'd like to talk a little bit about what we've seen in the portfolio and the economy over the past month. This episode was recorded on July 1st, 2025, and the discussion reflects composite portfolio data and analysis of recent government reports that are accurate as of that date. First, I would just say this is one of the craziest quarters I can remember in 25 years of covering global macro. It of course began with Liberation Day. That was April 2nd. And I think that initial tariff schedule was, effectively a recipe for global depression. It was quickly suspended, thankfully. And the market response to that suspension has been nothing short of remarkable. The S&P 500 finished the quarter up about 9%. I don't think anyone could have possibly anticipated that at the start of the quarter. But it's not just the way the financial markets have responded. When we look at our data, it looks as though the U.S. economy, at least real final demand, expanded at about a 1.7% annualized rate during the quarter. The unemployment rate looks to have finished the quarter at roughly the same levels that it began. And also, there was really no price impulse. You had inflation that finished the quarter at about a 2.4% increase from year-ago levels. Core inflation about 2.7%. Again, in both cases, almost precisely where those year-over-year increases in the price level were as of March of 2025. It's not as though the suspension meant that there were no tariff revenues collected. Our data suggest that there was about $24 billion in tariff revenues collected in June, and that brings the total for the quarter to about $62 billion. So that's equal to about 0.5% of GDP. So these costs are very evident as it relates to government receipts, but not so obvious in terms of where they're being incurred in the economy. I think that much of this is explained by that extraordinarily large inventory accumulation that we observed in the first quarter of 2025, and really also including December and in the immediate period after the election. Our data suggests that inventories, and this is retail, but mostly components, parts, other inputs, peaked at about 40% above year-ago levels during the middle of the second quarter, and now are down to about 15% as of June 30, above where they were a year ago. And so now I think we've reached the point as those pre-tariff inventories, the pre-tariff priced inventories are drawn down, that the rubber is really going to hit the road. And I think going forward, we are in the third quarter going to see some adjustment. Whether that adjustment takes place in terms of prices, higher consumer prices, whether it's reductions in output as businesses perhaps worry about demand, the strength of demand in their end markets, choose instead to focus on cost reductions. Of course, that could mean headcount reduction, so decline in output, or if we just see a narrowing of operating margins. But there will be some combination of those three variables, I think, that are almost certain to adjust in the third quarter. There's also, of course, the question of whether the 90-day suspension of the tariffs is renewed. I think that, to me, there's not much appetite. I don't sense much appetite for going back to the tariff schedule that was unveiled April 2nd. But of course, there's some uncertainty there as well. So we'll see. I do think that rate cuts are likely to come, probably September. I don't think there's sufficient data today, or at least sufficiently negative data, to justify a July cut, despite some political pressure for the Fed to move sooner. But I also would just note that inflation is still above the Fed's target. Sometimes when you hear about this pressure to move and the tardiness of the Fed of responding, you get the sense that the U.S. is on the cusp of deflation. But in fact, again, core consumer prices up about 2.7% from year-ago levels. Much of the weakness in inflation is attributable, of course, to still fairly sizable declines in year-over-year spending on energy for many of the businesses in the portfolio, and of course, some decline in food prices observed over that period of time. So again, I think that it's going to be an interesting third quarter. I don't suspect it will be quite as fascinating as the quarter that just concluded, but I do think that we'll see some of the adjustments in the data that we may have anticipated would arrive in Q2. And I do think it's highly likely that when looking back from the vantage point of October of 2025, that we will have seen at least one rate cut in response to those developments. So with that, let me turn to Jeff. And Jeff, thank you so much for coming on this month.
Great. It's a pleasure to be here. I'm looking forward to discussing European defense.
Yeah, no, it's a title I enjoyed very much, a play on words, the new Marshall Plan. Of course, this is MARTIAL, but making reference, of course, to the Marshall Plan that implemented after World War II that essentially rebuilt or helped to facilitate the rebuild of the European economies and industrial sectors. And I think that is, of course, what is likely to happen here as well. So, Jeff, let's just set the stage for the paper. You open by referencing the breakdown of the post-World War II order and the retreat of the U.S. And of course, this paper is a follow-up in many ways to the new dual order and the new realities of energy market. And this is in many ways, I think, the implications of that from a security perspective. But part of this is a coming capital rotation towards Europe, driven by valuations, fiscal capacity, at least relative to that of the United States, and most importantly, strategic imperatives. And are you seeing any signals that this rotation that you described is underway today?
I think we're in the early innings of it, and you can see it in the reflection in the euro and equity markets in Europe. And what I would argue is really an unwind of the capital misallocation that goes back to '08 or all the way back to the fall of the Berlin Wall in 1989. And if you go back to, let's say, like the GFC, the U.S. had more fiscal stimulus, more monetary stimulus since then, and it had more capital being directed at it and more plumbing to accommodate it, and the banks were more capitalized. And I think that attracted a lot of capital into the U.S. I think another point is the technology boom, the Mag 7, and as we'll probably talk about today, is the importance of R&D in the establishment of big tech in the United States. And again, that attracted a lot of capital. And then the final one, which is the flip side of global trade, is that as the U.S. backs away from trade, by definition, an accounting of it is you're going to see capital flows going back out to the rest of the world. And I think what we're witnessing is a more evening dispersion of capital around the world, and we're just in the early beginnings. And I like to point out, in my career, I've lived through two of these big capital rotations. One was in '02 and '03 when capital left Silicon Valley and went to the BRICS story. And then the other one was in 14 and 15 when it left BRICS and then went to the U.S. And when we look at the BRICS story, what's going on in Europe is of similar magnitude. It was a $10 trillion investment boom in the 2000s, which in today's terms is around $16 trillion. So I think what we're witnessing here is something very similar. Is you're opening up an opportunity in the part of the world where capital has not been attracted, going back for decades, if not, 3 or 4 decades. So I think it's a very interesting time we're living through in terms of thinking about where capital is rotating towards.
And one other point on capital rotation that I found very interesting in the paper was thinking in terms of physical versus intangible assets and the way that the relative importance of intangible assets sort of hit this peak. And you mentioned 2002. Well, that was almost precisely the time that capital moved back towards the importance of physical assets, productive capacity, industrial equipment, and PP&E. Do you see the same sort of thing unfolding today as it relates to that capital rotation?
Absolutely. And in '02, '03, we coined the term the revenge of the old economy. That's the point you're making towards, old economy, commodity related, defense related, manufacturing. And in fact, if I had to coin an acronym for it, I'd use MITE, MITE, manufacturing of defense, infrastructure, technology like drones, and then energy infrastructure, MITE. And that's all just physical, old economy type assets that where you're going to see a lot of that development. So, this is more similar to the 0203 type rotation than it is to the one in 1415, which was the other direction. By the way, if you just look at interest rates, inflation, they go through these 20 to 30 year type cycles, which, by the way, is also the lifespan of most physical assets. So it's not a surprise we're at the cusp of this transition. And I think you hit the nail on the head. Why did I gravitate towards this subject? Because it's dear to my heart and very close to this whole idea, the revenge of the old economy, because it's physical assets. It's the tangible, as you like to point out.
In the past, I'm based in Washington. We think about, these issues. I think about these issues, I guess, from a Washington perspective. In the past, when U.S. presidents or governments would sort of pester their counterparts in NATO about defense spending, really what they were talking about is buying more U.S. hardware. Sort of the sense that you're living under a U.S. security umbrella. It's time for you to spend more money on F-35s, on other defense systems. That's not at all what we're talking about here.
When I think about the question of why now, and what's driving the U.S. retreat, and I think it goes to a broader point. The U.S. is just not scared of the same things it was scared of many years ago. It's not fearful of the communists. It's not fearful of Russia. It's making a pivot towards Asia. And I think another really important point is it's not afraid of running out of oil. And I think we saw that this past weekend in Iran and Israel, when the U.S. was willing to go in there and drop bunker-busting bombs on the potential nuclear enrichment programs. It would not have done that 5 or 10 years ago because it was afraid of disruption in the Straits of Hormuz. And so, I would really chalk it up to three factors. One, it's no longer afraid of the same forces as it was before, i.e. Russia. And by the way, Russia's getting more aggressive on Europe. And I think the second one is it's no longer fearful of running out of oil because of energy independence. And it was important how that oil factor came into play is because it had to police global supply chains and supply lines when the strategically most important commodity, i.e. oil, was being imported into the United States. A third factor I put in there is the higher interest rates, which are just reflecting a much more difficult environment inside of the U.S. When you look at your debt to GDP ratios, it's back to the same levels it was before World War II or during World War II. When you look at income inequality, it's back to the same levels when tariffs were this high, back into the 1930s. And you also look at market concentration. It's off the charts, which hurts consumer surplus. So the U.S. has a looming battle with its own bond market as opposed to thinking about geopolitical issues in places like Europe and Russia right now. So there's a lot of factors at play as to, the why now. But I think, the big key here is they don't want to put the money, time, and effort in defending a part of the world where the risks simply do not justify the costs.
It was interesting, if you go back a year ago to the Draghi report, you're looking at European defense expenditures. About 78% of European defense procurement was sourced outside of Europe. Also, even more importantly, from his perspective, was when you look at R&D spending, something that you focus on in your paper, the European levels are 1/12 to 1/15 that of the United States. And so again, rather than buying from the US or continuing to source things externally, what you're talking about is a complete rebuild of a defense industrial base.
I wouldn't even call it a rebuild. Europe did not invest in a military industrial complex following 1945. It couldn't. It had to feed people and rebuild basic infrastructure following 1945. So I'd argue it's not so much a rebuild as it's the beginning of one. But I think your point on R&D, I think, is incredibly important. Many macroeconomists will point out that when you look at defense spending, it doesn't have a big cyclical multiplier to it. And that's absolutely true from a demand perspective. But the one thing those econometrics cannot capture are the structural shifts from a supply side perspective. When we look at the US, the benefits of the military industrial complex are significant, whether if it's GPS, internet, AI, the list goes on and on. I like to point out Silicon Valley has the name Silicon Valley because the US needed some type of chip that wouldn't melt in the B-70 bomber or Minuteman missile. And so a lot of the tech dominance that exists inside the United States is a direct result of that military defense budgets. And I think your point about the R&D, when you look at the R&D, it has this huge impact on the ability to create new and innovative types of products that have served both civilian as well as defense purposes. And the one I like to point out is mobile phones. Before Apple, the dominant player alongside Samsung was Nokia. And what does Nokia, i.e. Finland and Korea, where Samsung is, have in common during the Cold War? They were the hottest borders out there. And they had to police up and down the border. And the way they did that was with mobile phones. And that's how they became so proficient in their ability to do mobile phones. And it's not a coincidence that soon as the collapse of the Berlin Wall happened and the peace dividend kicked in, that Nokia essentially disappeared because they didn't have that same type of backing. So I think the key point here, as you allude to, is the benefit of a large R&D budget that benefits technology. It goes back, why are the Mag 7 in Silicon Valley in the United States? A lot of it has to do with the substantial R&D budgets that are tied to the military industrial complex.
Yeah, no, it's a great point. And there is a passage from the paper that I found especially interesting because when you think about this defense spending, it's almost always characterized as a burden. The burden of defense falls on the U.S., it falls on U.S. taxpayers. But as you write, this burden hasn't held the economy back, even in relative terms. America may have carried a larger defense burden than its allies, but this was neither a disadvantage for the U.S. nor an advantage for those allies. If anything, it was the reverse. I'm interested in this dual use concept, just the commercial spillovers. What do you anticipate in terms of the impact on the European economy? Do you expect that this could facilitate the development of a European tech sector, which, of course, has badly lagged that of the United States?
Absolutely. I mean, when you look at which two countries in the world have the largest military and R&D expenditures, it's Korea and Israel, or Israel's number one, Korea's number two, the two most dangerous places in the world. Look at the tech innovation that comes out of both of those countries. It's astounding. And so as Europe begins this journey, similar to what the Americans did in the 60s and 70s when it was Fairfield Semiconductors that launched Silicon Valley, I think the spillovers and productivity impacts are going to be tremendous here. And we haven't even scratched the surface on the potential CapEx boom that will be tied to all of this. So I think it's significant.
So let's talk about that. Obviously, in the paper, you talk about 4 to 14 trillion euros of spending. That's an enormous sum. Of course, there is immediate concerns about whether that could be squandered. And, the premium and attention that should be paid on ensuring that this money is spent judiciously. You spend a lot of time in the paper talking about how to coordinate, how to ensure the fact that, of course, in wars or you're investing in the defense space, it's not until conflicts, perhaps, that you realize that the money was not spent wisely. So this is really, again, a coordination premium. I was wondering if you could discuss how to think about ensuring that this money is spent prudently as possible.
I think another important implication that we can draw upon the U.S. in places like Silicon Valley was the military industrial complex in the United States created the private markets. It started out with VC in the 50s, and then it evolved into more of a private equity type structure. But let's ask the question as to why did the U.S. government depend upon private markets? You cannot leave something as important as defense and technology to the vagaries of the public markets. And equally, you don't want to leave it all in the hands of a bureaucrat. So the happy medium that was developed is the idea of a private market where you can have one person that you deal with, who you talk to, who can help deal with many of these coordination problems. So private markets were created precisely for this kind of capital deployment that we're likely to see taking place in Europe. That's why the subtitle to the piece was Back to the Future for Private Markets, because it is the most optimal way. It's a happy medium between the public markets and a bureaucrat in terms of creating and overcoming these coordination issues. As we like to say with private markets, it's a complexity premium for complex problems.
Yeah, and also you talk about the structure of the defense industry in Europe and how it differs from that of the United States, and that also, I think, lends itself to private market solutions.
When we look at Europe in particular, I think one of the issues there is a large base of small private companies. It's like they didn't completely give up on defense spending, and so when we look at the broader let's take France. They have a database of 4,000 companies that are potentially dual purpose. So I think the space here, particularly in the private side, is very ripe in terms of finding potential companies that will flourish in this new environment. So again, I think going back to the point that the complexity, the coordination issues that need to be dealt with, private capital is ideal for solving these problems.
And there's also, of course, questions about the fiscal capacity of European states, what was committed at The Hague in terms of the increase in defense spending, the expectation that much of the incremental spending will be debt financed. How do you respond to some critics who at least raise the question about whether this is doable from a fiscal perspective?
I think it is a big question mark right now, but I think let's first start with the macros. Europe has one of the lowest debt to GDP ratios of any industrialized country. The US is 125, China is close to 300, Germany's 60. Continental Europe, if you add in the UK and some of the southern countries, it gets up to around 81, 85. But I think the key point here is it's a lot lower than any of the other industrialized nations out there. The other point, too, is when we look at income equality. Europe has the best income equality of any of these industrialized countries around the world. I mean, one of the big benefits of the joke people say is Europe is the superpower of regulation, is that consent to create unification has a lot of benefits that it can now start to monetize to attract capital to the space. So that's the macro setup, but then you're going to go, well, what about the coordination issues across the different regions? And we're already seeing it happen. In fact, Jason, I think you sent me an email a few weeks ago talking about that safe bond, 150 billion, that shows that they're willing to cross borders and they understand the importance of doing this. But I think the last point, which goes to a bigger issue, is this is existential for Europe. They have to do this. The U.S. is retreating. Russia is becoming more aggressive, and Europe is waking up, which means they have to come to some type of ability to overcome some of these differences to be able to create an environment which is far safer for them. And the benefits, as we talked about earlier, are also tremendous. So I think given the existential nature of this, the probability of them being able to solve a lot of these issues, I think, are going to be significant. Now, they've had 75 years to overcome many of these differences, and the U.S. gave them that protection. And I think that at this point in time, if they can't do it now, when are they going to do it?
So enormous increase in defense spending, rather than again being sourced from the United States or imported hardware. This is going to be domestically sourced. Obviously, enormous supply chains required, industrial base. Does Europe have the energy that's required to do this?
I actually would argue that Europe is very well positioned from an energy perspective because they have all that capacity of renewables that is installed. A joke I like to point out when we look at, I think many of you remember that big problem that Spain and Portugal had about a month and a half, 2 months ago. About 2 or 3 weeks later, France had a problem. By the way, they blamed it all on solar in Spain and Portugal, blamed it on nuclear in France, and then New Orleans had one about 2 or 3 weeks ago, and they blamed it on gas. It's not gas, it's not renewables. What is it? It's grid, it's infrastructure in all three locations. And I think that as they build out the infrastructure, batteries, chemical storage, they'll start to be able to monetize that. But the other really big one is I'm pretty bullish on all commodities, but a very few. And one of the ones that is clearly oversupplied is LNG. And LNG really starts to see big surpluses, come 2026, 2027. And where is most of that LNG going to go? It's going to go into Europe. And one of the questions you can ask, will it go into China? The answer is no. China is really pursuing a domestic first policy, whether it's with renewables or with its own nuclear power. And unfortunately, coal. They burn a lot of coal. And so I would tend to believe that the place where this is going to be directed is going to be in Europe.
Great. Well, thanks very much, Jeff. Again, I highly recommend that people go to the Carlyle website, the new Marshall Plan. I think that the points about the complexity premium, the need for private capital, just the way you describe the lead times, the Lego analogy, that may be something, I don't know if you want to expand on that. I thought that was also very helpful to understand the general approach.
Yeah, I think that the Lego approach is take Airbus. Airbus is built in UK, Spain, France, and Germany. And each country provides parts to Airbus, and then it gets assembled down like a Lego with a child down in Toulouse. And so I think they have the tools at their disposal to be able to think about trying to create these cross-border coordination problems that I think many people highlight that will likely get in the way here.
Yeah, well, again, a fascinating report. Highly recommend everyone go to the website, the new Marshall Plan, and also very, very clever title. So I credit you with that. But Jeff, thank you so much for joining us this month.
Great. It's a pleasure to be here, Jason, and thanks for the time.
As always, thanks for listening, and I hope you'll join us for next month's episode of Insights and Indicators.